Joining me today is Matthew Kerkhoff. He's a research director over at Richard Russell's Dow Theory Letters. He joins me on the spot. Joining me from San Diego now is Matthew Kerkhoff. Matthew, thanks so much for being with us.
Oh, absolutely. It's a pleasure to be here.
So we have a few central bank meetings this week, Matthew, but it seems everyone will be paying attention to the ECB's meeting this Thursday. Europe's inflation numbers were released last week, and this raised concerns in the Eurozone for deflation once again. Matthew, do you think that Draghi is under pressure to continue easing here? What can we expect of Thursday's meeting?
Yeah, you know what? I think he is. This is we just got data released and shows, again, record low inflation levels. And so everyone's going to be looking to Draghi to do something with the euro, whether it's cutting rates a little bit further or actually starting to engage in some type of quantitative easing. I do believe the pressure is mounting for him to make a move.
So given the direction the U.S. Fed and the ECB seem to be headed in, Matthew, what can we expect for gold? I know you focus more on the technical side, but what are some key indicators you're looking for? Well,
on the technical side, we're still seeing a little bit of weakness in the gold markets. But we do have a double bottom, and 2014 has been good to gold so far. With continued easing out of the ECB and around the world, it's likely gold will still be supported. And in the long run, there's a lot of long-run positive catalysts for gold. So we're very much long-term bullish on gold.
So long-term bullish on gold based on which reasons?
So there's a couple of reasons. The Fed has basically promised us roughly 2% inflation. And there's a very strong history of them delivering on that promise. So we expect that to continue. Gold has typically been a fantastic inflation hedge, and we expect it to remain so. And then beyond that, there's two additional factors. There's a lot of speculation right now about manipulation in the gold markets. Essentially, a lot of large institutions selling naked shorts in the futures market and driving the price down. And that doesn't really correspond with what we're seeing in the physical markets for gold. On the physical side, it seems like there's quite a bit of demand. And so we're watching things like the amount of inventory at the COMEX and the GLD. At some point, if some of these larger exchanges run out of physical gold, there's going to have to be some type of a reset in the gold price to realign sort of the paper market demand and the physical market demand. And so if and when that happens, that's going to be a major upward catalyst for the price of gold.
Matthew, let's look at a recent article you published in regards to China and whether or not the country is leading up to a financial crisis. And you look to an interesting chart that the Wall Street Journal published, which shows the rise in China's debt levels compared with other countries before their respective financial woes and how similar these levels are. What do you make of this data, Matthew? And do you think a credit crunch problem will hurt China?
Yes, judging by their debt to GDP levels, it is rather alarming. And that particular chart compared their debt levels to other countries prior to their respective crises. And while it is alarmingly similar, I wouldn't say that a collapse in China is inevitable at this point. But China is on our radar as one of the largest risk factors at the moment. We saw just the weakness in their PMI numbers last week basically triggered, the cascade in currencies that we're seeing across all the emerging markets. So they are definitely very, very high on our radar.
All right, before I let you go, Matthew, I know you track gold, silver, platinum, and palladium. Is there one metal that you're preferring right now?
We generally prefer gold. And a lot of it has to do with just the amount of economic uncertainty that's unfolding around the globe. Gold is always looked at as a nice safe haven. When investors panic, they typically retreat to items like gold and treasuries. And so that tends to be where we focus most of our attention.
And a short-term trading range that you're looking at for gold?
Short-term, if gold can break out above about 1260, 1275, above its short-term downward trend line, then we'll be looking for more positive action after that. But unfortunately, we're still below that declining trend line at the moment. So we got to go with where prices are heading.
Thank you for joining us, Matthew. We hope to see you soon.
Absolutely. Thank you very much.
And thanks for watching this edition of On the Spot. You can email us at newsfeedback@kitco.com or follow me on Twitter at Daniela Cambone. Happy trading and happy week.